Hello, everyone. Today we have why a central banking official and a Fed governor both want the stock market to go down. Their predictions on interest rates, their predictions on inflation, and overall what to do with your money over the next up and coming quarters to have the best risk management portfolio that you can build. So let's get right into it. The Federal Reserve needs to keep raising interest rates to get inflation under control. Very first line, like at least buy me dinner first. You know what I'm saying? So even though we saw better than expected inflation at 7.7%, they still need to keep raising interest rates because we are not out of the blue yet. Um, so we'll go into some numbers. Excluding volatile food and gas or energy, everything else rose 0.3%. If you included those, they rose everything rose 0.4%. Um, so yeah, what kind of happened? We saw a nice market rally over the last couple of days once the numbers came out. S&P was up like 4.5%. Nasdaq was up like 7%. Just absurd numbers not seen since pandemic 2020. But right at the gates, yes, again, investors overreacted. They thought that the new inflation numbers would mean the Fed would ease their rate hikes. Unfortunately, it does not seem so. Um, and we have a couple reasons why. One, we have a ways to go. Still, we have a long ways to go. We are still very high in inflation. There are a lot of positives, but we still have a long ways to go. Right? They want more evidence. They want more evidence. Um, and we've seen this. We've seen months where inflation ticks down, right? But that doesn't mean the inflation trend is fixed. Doesn't mean all these problems that we have are fixed. So yeah, we've had several instances over the past year where inflation appeared to slow only to jump higher later. July and August, we saw major rallies in the end of the summer because inflation looked like it was ticking down, and we're in a very similar spot, unfortunately. Um, so yeah, let's just kind of go over what raising the rate does, right? It combats inflation, higher borrowing costs, lower stock prices. Okay, they need lower stock prices to combat inflation, and so that right out of the gate tells you if stocks increase, inflation increases, and they do not want that. They do not want inflation to increase. Therefore, they are going to have to come out, use every tool in their book to get stock prices down so they do not increase, undoing the Fed's work. We've seen this time and time again. They've come out time and time again saying they do not want to see a market rally. And we're probably not going to see a market rally until the next numbers, or maybe even the numbers after that. Right, December 13th is a really big one. If stocks rally before that, those inflation numbers could get all messed up, and they could actually increase, and that would be devastating. But if stocks don't rally and the Fed's work is doing what it's doing, interest rates are doing what they're doing, we could see some good numbers, and that would lead way to a more sturdy market rally. Right, we saw markets rally in July and August, and the same exact thing happened. The next couple of days, Powell had to come out and clarify to investors that he is not backing down and that we are not out of the blue yet. Yeah, exactly the same situation we had in July. And July looked like a nice 17% run up. And then we made lower lows when newer numbers came back in. So we have to be very, very cautious because, fool me once, shame on you, fool me twice, shame on me, shame on us. Okay? So we got to be very cautious and not make the same mistake we made last time. Now, so even though officials did not release new rate projections this meeting, Powell said that if they had, they would have been higher. They would have increased the overall terminal rate projections from 4.6 to who knows 5.25. But they didn't give the numbers yet because there's so much uncertainty that even Powell cannot give correct numbers. A lot of that had to do with strength in the labor market, high inflation readings, etc. So slowing down rates versus getting to a specific peak of interest rate. We can slow down the rate increases to 50 basis points and then still see 6% as its peak. That is possible. That's what the general consensus is kind of leading to. You know, we're moving back from 75 down to 50. Oh, yay. But we're going to do 50 for 2 extra quarters. That's kind of how it works. So I got to this page right here, and it devastated me a little bit. It devastated me, right? So what are a couple things it says? First of all, the minute that the Fed said they were leaning towards slowing rates, they knew the markets were going to jump for joy, and so they immediately had to drive the points home that slowing interest rates would not mean the Fed was closer to ending them instantly. So they came out with these 50 basis point hikes with a plan to combat a market rally. And it doesn't seem like it's working very well, so they might have to implement even more things to actually get the market down. And this right here, jeez. Okay, so Fed governor said that he was surprised that financial markets hadn't shown more stress amid the rapid interval of rate rises this year. He was also shocked at the resilience of the labor market. 4 straight quarters of 75 basis point hikes. Not done since 1994. This should have been a lot more detrimental, and of course there's a lag, and so we're not going to see it yet, and so we will see it in 2023. They are surprised at how little effect these rates have thus far, which can only mean 2 things. One, we will see the effect into 2023, or 2, they're going to have to do more, interest rates higher, more tightening. So either way, this is very, very bad. He is surprised at the lack of stress and the resilience of the market, which is the opposite of what you want in this time. So they are going to potentially have to do a lot more. And yeah, he comes out and says the monetary policy, I guess, is not that tight. So very unfortunate. This article is not great. It means we could come out, or they could come out and raise interest rates even more and do even more tightening and cool the economy even more, because apparently it's not doing anything yet. So keep that in mind, stocks wise, investing wise, and yeah, have a good day.